Microsoft recently reported earnings, and the headline numbers were strong. Revenue up double digits, profits up, and Azure still growing fast. But the stock reaction tells you what investors are really focused on right now. Today, I'm breaking down the numbers, the charts, and I'll give a one-year price target you need to hear before you decide if it's right for you. Let's generate alpha. Here are the key numbers. Revenue came in at $81.3 billion, up 17% year over year, beating expectations of $80.27 billion. Operating income was $38.3 billion, up 21%. Earnings per share on a non-GAAP basis was $4.14, up 24%, beating expectations of $3.97. Now, a really important detail. Microsoft's GAAP net income was boosted by net gains from its investment in OpenAI, and Microsoft called out the size of that impact in the release. So for core operations, most analysts focus on the non-GAAP view to compare apples to apples. Microsoft breaks revenue into three big segments. Here's what they did this quarter. Productivity and business processes. Revenue was $34.1 billion, up 16%. This includes Microsoft 365, LinkedIn, and Dynamics. This is the steady engine part of Microsoft, highly sticky products, recurring revenue, and strong pricing power. Intelligent Cloud revenue was $32.9 billion, up 29%. And here's the line everyone watches. Azure and other cloud services revenue was up 39%. That's a big number. It says demand for cloud plus AI workloads is still strong. More personal computing revenue was $14.3 billion, down 3%. This includes Windows OEM, gaming, and search. So overall, cloud and productivity are driving the bus. Consumer-ish areas are more mixed. Now the big highlight that spooked investors, capital expenditures were up 66%. This scared investors mainly because spending surged much faster than the visible payoff. The company dramatically ramped investment into AI data centers, GPUs, and cloud infrastructure, pushing quarterly capex to unusually high levels relative to history and analyst expectations. As for forward guidance, Microsoft expects next quarter revenue of $80.65 to $81.75 billion. They also expect Azure growth of 37 to 38%. If those hold, it suggests demand remains resilient, but the market will judge that against the pace of spending. Let's look at the charts as the stock has taken a huge hit since the earnings release. With the price below the 50-day moving average, the medium-term trend is down. Rallies often run into selling pressure near the 50-day. The price is also below the 200-day moving average, suggesting the long-term trend is down. Because the 50-day is also below the 200-day, that signals a bearish alignment often associated with downtrends until the price can reclaim these levels. The relative strength index is currently at about 34, which is near the typical oversold threshold on the 14-day RSI scale. Since the current reading is around 30, many traders interpret that as the stock being closer to oversold momentum, potentially a signal of weaker recent price strength or an upcoming technical rebound. What would turn the chart more bullish? RSI pushing back above 50, ideally while price reclaims the 50-day moving average, then starts putting in higher highs and higher lows. Longer term, holding above the 200-day would be the bigger confirmation the downtrend is ending. If you're thinking long-term, years, not weeks, then this setup is generally favorable. Now the bear case, what could go wrong? Here are three of the biggest risks facing Microsoft stock right now. While revenue and earnings still beat forecasts, cloud and Azure growth did not accelerate enough to convincingly match the scale of capital expenditures growing 66%. This created a perception that Microsoft is front-loading massive costs today, while the monetization of those assets may arrive later than investors had hoped. Azure is Microsoft's primary growth engine. If cloud growth slows due to competition or macroeconomic weakness, it would materially impact overall revenue growth. Since Microsoft's stock price assumes double-digit growth, any deceleration in Azure could trigger share price volatility. Competition is a major risk because it directly pressures the company's most important growth drivers, especially Azure and AI. Microsoft competes head-to-head with Amazon Web Services and Google Cloud, forcing Microsoft to spend more on data centers, chips, and incentives to retain customers. Even within software, rivals like Google Workspace and collaboration platforms continue to nibble at Microsoft's dominance, limiting long-term pricing power. While Microsoft is unlikely to lose its market position, rising competition could slow growth. Now the big question, where could the stock go from here? At today's price, around $413, and a forward price-to-earnings ratio of 23, Microsoft is not cheap, but it's still one of the highest quality tech companies in the market. Most analysts maintain a buy rating with an average price target of $603. Looking at the discounted cash flow model, the base case estimated value for the stock is about $378, and the best case is $665. Please be aware that DCF is highly sensitive to assumptions. Even small changes to growth or discount rates can swing the fair value dramatically. As for my opinion, I am giving Microsoft a buy rating with a one-year price target of $550. Here are 3 reasons why I believe it's a buy. First, Microsoft isn't just selling AI features. It's building a massive enterprise. AI stack across cloud infrastructure, productivity software, developer tools, and business applications. This creates a powerful ecosystem where AI becomes embedded into daily workflows, driving recurring subscription upgrades rather than one-off sales. Over time, this positioning gives Microsoft multiple monetization levers and the ability to compound AI revenue across its existing customer base of hundreds of millions of users. Second, Azure remains one of the world's largest cloud platforms and a core earnings engine. Even if growth fluctuates quarter to quarter, the trend toward cloud migration, data analytics, and AI workloads strongly favors hyperscale providers. As AI workloads expand, they are extremely compute-intensive, meaning each incremental AI deployment drives more Azure consumption, strengthening Microsoft's long-term revenue. Third, Microsoft consistently generates massive free cash flow, supporting dividends, share buybacks, and strategic reinvestment at the same time. This financial strength allows the company to fund aggressive AI expansion without threatening its balance sheet or shareholder returns. For investors, this means exposure to high-growth AI trends, plus the stability of a mature cash-generating business, a rare combination at Microsoft's scale. Bottom line, Microsoft combines platform dominance, cloud tailwinds, and elite cash generation. If AI becomes as transformative as expected over the next decade, Microsoft is positioned to be one of the biggest long-term winners, making the stock attractive for patient investors. Thanks for watching. If you enjoyed this video and want more earnings recaps with one-year price targets, please like and subscribe. Until next time, keep earning, keep saving, and keep investing. This is not financial advice, just my personal opinions. Make sure you consider your own risk tolerance, time horizon, and financial situation before making any investment decisions.